Welcome to the Video CPA. I'm Michael Scott, I'm your host, and today we're talking about depreciation recapture. This will be our third installment in the depreciation series and probably our final installment for a while. We've talked about straight line depreciation, we've talked about accelerated depreciation, and now we're talking about recapture of depreciation. So let's go ahead and get into it. Like I say, I'm Michael Scott. I'm a certified public accountant, a certified management accountant, and I've got a master's degree in accountancy and 45 years of experience, and I enjoy making these videos. So let's go ahead and proceed on with this one. The first thing you'll see is our affiliate disclaimer saying that if you go to the comments section on this video or any other video and press on one of the links and go to the vendor and buy something, we get a commission. And you need to be aware of that, and we like getting commissions, so go ahead and do that if you're so inclined. Next thing you see is the video educational disclaimer. You've seen this one before, so I'm going to go by this one pretty quick. Now, let's talk about depreciation recapture. Primarily what depreciation recapture means is that if you buy an asset, for example, and that asset has to be depreciated, as assets do, you're going to get deductions during the lifetime that you own that asset. So when you sell it, the IRS is basically saying with depreciation recapture that they want those deductions back. You're not going to be able to keep those deductions forever. So what most people think is that if they buy an asset for $10,000 and they turn around and sell it for $8,000, that their gain is only $2,000. But if they bought the asset for $10,000 and they've taken depreciation on it for $5,000, well, then their gain, instead of being $2,000, is, and this is still assuming they sell it for $8,000, their gain will be $3,000. A lot of people aren't aware of that, and they're surprised by it. But that's what depreciation recapture is, and what it means is it's the part of the gain that is taxed at ordinary income rates. So let's look at some terminology that will help you here. We've got two sections in the IRS code that govern depreciation and govern depreciation of personal property and govern depreciation of real property. So 1245, section 1245 is personal property, section 1250 is real property. And those two sections govern the tax rates and how the gains are treated on these two types of properties. So you need to realize that when you have a gain on the sale of an asset, there is usually two parts of that gain. One is the depreciation recapture part, and the other is the capital gain part. And so Section 1245 and Section 1250 determine how those two parts are taxed. For example, 1245 property, if there's a gain on that, the depreciation is recaptured, and that depreciation is recaptured and taxed at ordinary income rates. Okay. With Section 1250 property, the depreciation is still recaptured, but that depreciation that's recaptured is taxed at a 25 maximum capital gain rate. And so, two parts usually: the depreciable property part, and then the capital gain portion of the gain. And so, let's look at an example. This is section 45 property. Section 1245 is an example. In this, Bob buys personal property, keeps it for 3 years. He bought it for $20,000. He's going to turn around and sell it for $15,000, but he took $8,000 worth of depreciation on it. So in calculating the gain, we take the sales price of $15,000, we take the cost of $20,000, and we minus the accumulated depreciation for an adjusted basis, in this case of $12,000. So in this particular example, the gain is only $3,000. Now, when you recapture depreciation, that's applied to the gain before anything else. And so in this case, we had to recapture $8,000 of depreciation. The gain is only $3,000, so in that entire $3,000 is ordinary income. Now, if this had been a little bit different example, and the gain was $10,000, the depreciation still was $8,000, and the gain had been, in this case, like I say, $10,000. $8,000 would be recaptured at ordinary income rates, taxed at ordinary income rates. The remaining part of the gain would be taxed at capital gain rates, a maximum capital gain rate of 20% in this case. So that's a 1245 property. So you just need to remember that that depreciation recapture is not at capital gain rates, and it does have to be taxed, and it's at ordinary income rates. Let's look at the 1250 example then. We've got Bob again. He's bought a property for $240,000. He's allocated $40,000 to the land, making the depreciable basis of the structure $200,000. Over the years, he's depreciated $72,000 on a straight line basis. And he turns around and he sells the property for $350,000. He allocates $50,000 of the selling price to the land. And so in this particular example, the land is treated as a separate transaction, and I advise that you do that you treat the land as a separate transaction. Both when you, on the front end, you've got to separate it out because you don't want to depreciate it, and on the back end, you want to sell it separately, and it usually yields a better tax result. So in this case, the sales price of the structure, $350,000 minus $50,000 that was allocated to the land, is $300,000. Then you've got your adjusted basis. He paid $200,000 for it. He had $72,000 worth of depreciation. So the adjusted basis in this case is $128,000. Now the gain on the sale then is $172,000, and we have to divide that gain out between the recaptured depreciation and what is called in the tax code is an unrecaptured Section 1250 gain. Now why they call it unrecaptured, I don't know, because we're recapturing it right here, but it's called an unrecaptured Section 1250 gain. And so two parts, the unrecaptured Section 1250 gain and then the capital gain part of it. So $72,000 is the unrecaptured 1250 gain, and $100,000 in this case then would be taxed at capital gain rates of a maximum of 20%. So that's the way the Section 1250 example works. I want to thank you for watching. I've got a free ebook for you. I wrote this book several years ago, and it's in ebook format, and so if you'd like a copy of it, send me an email at michael@scottandscottcpa.com, and I'll send that out to you. Thanks for watching. Thanks for subscribing. And by the way, if you need more detail on any of these subjects that this video is about, we have started our Video CPA Tax Preparation School, and those lessons are in much more detail than what the videos are. So if you want more videos, more detail, you might visit that site, www.thevideocpa.com, and you can enroll in that school, and right now you can take those lessons for free. Again, thank you for watching. If you haven't subscribed, hit the emblem below and subscribe and become part of our family.